The silver market erupted in chaos today as prices began a rapid descent that shocked investors around the world. In just the first hour, silver fell nearly 7%, sending portfolios into immediate loss mode. Rumors spread that Morgan Stanley, one of the largest financial institutions globally, had started panic selling nearly 70% of its silver holdings, creating an unprecedented wave of fear. Investors stared at their screens in disbelief, realizing that positions they had held for years were evaporating almost instantly. The drop from around $25 per ounce to $23.50 created a ripple effect, triggering automated trading systems that magnified the decline. Sell orders surged by over 75%, accelerating the market collapse in mere minutes. Long-term investors were caught off guard, as portfolios lost up to 10% in value within hours. The panic spread quickly, amplified by social media speculation and news headlines warning of further drops. By mid-morning, silver had already lost nearly 8%, a level of volatility that had not been seen in decades. The cascading effect was brutal. Every small sell order seemed to trigger another, creating a chain reaction that pushed prices down further and faster than anyone had anticipated. Analysts scrambled to explain the bank's strategy, suggesting it might be a preemptive move to protect larger financial interests or a response to undisclosed global economic signals. Retail investors and hedge funds alike were forced to react immediately. Those holding silver ETFs saw their accounts shrink dramatically, some losing $75 to $100 per ounce in just hours. Communities that had relied on silver as a safe investment suddenly felt vulnerable, and the emotional impact of the crisis became clear. Fear, uncertainty, and doubt dominated the market, pushing the sentiment index to nearly 80% negative, a level rarely recorded in financial history. Investors were left questioning whether the worst was over or if deeper drops were imminent. By the end of the day, silver prices remained extremely volatile, fluctuating up and down as traders tried to regain control. The market had exposed its fragility, showing how a single institution's decisions could cascade into a global panic. Even as night fell, the uncertainty lingered. Every investor was forced to weigh their next move carefully, knowing that any delay or hesitation could result in further losses. This was not just a market correction, it was a full-blown silver crisis, one that had captured global attention and reminded everyone how quickly confidence could turn into fear. The panic in the silver market continued to escalate as the second day of trading unfolded. By the morning, silver prices had already slipped another 3%, bringing the total drop to nearly 11% in just 24 hours. Investors who had held positions for months or even years were now questioning their strategies, as confidence in the market began to erode. Morgan Stanley's aggressive selling had created a vacuum in the market. Buyers were hesitant, sellers were desperate, and every trade seemed to amplify the downward pressure. The once stable silver market now resembled a storm, with rapid fluctuations from $23.50 down to $22.80 per ounce, leaving traders struggling to keep up. Small investors felt the shock most acutely. Many had invested in silver ETFs as a safe hedge against inflation, expecting slow, steady growth. Instead, portfolios that had risen steadily over the past year suddenly lost 5 to 8% overnight, a blow that left both seasoned and new investors scrambling. Social media platforms were flooded with real-time updates, charts, and speculation, with sentiment analysis showing nearly 85% negative reactions to the market's movements. Forums and chat groups became echo chambers of fear, where every drop was interpreted as the beginning of a deeper collapse. Analysts tried to piece together the reasons behind Morgan Stanley's massive liquidation. Some suggested that geopolitical tensions and uncertainty in global supply chains had prompted the bank to reduce exposure to precious metals. Others speculated that internal risk assessments revealed vulnerabilities that forced the firm to act swiftly. Regardless of the exact cause, the market responded violently, as automated trading systems and human panic combined to accelerate the decline. By midday, silver prices had hit $22.50 per ounce, a near 10% drop from the previous close, and the volatility index for precious metals spiked to levels not seen in over a decade. Hedge funds and institutional investors were forced to act quickly. Many reduced leverage positions, sold additional silver contracts, and shifted capital into less volatile assets. Even with these measures, the sheer speed of the drop meant that some funds faced losses approaching 12 to 15%, causing alarm across the financial sector. Retail investors, meanwhile, were faced with impossible decisions: hold silver and risk further losses, or sell and lock in the declining value. The emotional impact was evident, as many described the situation as a once-in-a-generation panic. In their investment lifetimes, as trading hours came to an end, the market had not stabilized. Silver remained volatile, swinging between $22.50 and $23, with every small news update or rumor influencing prices dramatically. Analysts cautioned that the crisis could extend beyond silver, affecting other metals and related industries, while regulators monitored the situation closely to prevent systemic risk. The silver market had become a microcosm of global financial uncertainty, where a single institution's decision could trigger widespread consequences. By the evening, the narrative was clear: the silver panic was far from over, and investors worldwide braced for more turbulent days ahead. The third day of the silver crisis exposed just how interconnected the global financial markets had become. By early morning, silver prices were fluctuating between $22.20 and $22.80 per ounce, reflecting a continued downward trend of nearly 12 to 13% since the initial panic began. Traders around the world were glued to their screens, monitoring every tick and every news update, knowing that even small moves could have major consequences. The atmosphere was tense, as investment confidence remained fragile and speculative activity dominated the market. Morgan Stanley's initial liquidation continued to influence trading behavior. Other major institutions, wary of similar risks, began reassessing their positions in silver and related commodities. Analysts reported that around 60 to 65% of institutional silver holdings were being re-evaluated, creating further uncertainty and slowing the market's natural recovery. Retail investors faced a difficult choice: hold on to silver in hopes of a rebound or sell to prevent additional losses. The emotional toll was apparent, as many felt trapped, unsure whether to trust market signals or act defensively. Global supply and demand dynamics also added fuel to the fire. Physical silver demand from industrial sectors and jewelry manufacturing showed signs of weakening, while speculative demand surged. Prices were further pressured by an increase in margin calls, forcing some traders to sell their silver holdings to cover leveraged positions. By midday, silver had dropped to $21.90 per ounce, a nearly 14% decline from the previous close, marking one of the steepest multi-day drops in years. Markets outside the U.S. mirrored the volatility, with silver-linked indices in Europe and Asia also falling sharply. Media coverage intensified the panic. Headlines screamed about a silver meltdown, while social media posts painted dramatic pictures of investors losing significant portions of their portfolios. Public sentiment surveys indicated that over 80% of small investors were worried about further losses, with many expecting a continued downward spiral. The psychological impact of the crisis became as significant as the financial losses themselves, creating a feedback loop of fear that kept the selling pressure high. By evening, market experts warned that the silver crisis could influence other commodities and even affect broader economic confidence. The interplay of automated trading, institutional panic, and global investor fear had transformed what might have been a manageable correction into a full-scale market event. Silver's price volatility remained extreme, swinging between $21.90 and $22.50, and analysts cautioned that the coming days would be crucial in determining whether the market could stabilize or whether the panic would continue to intensify. Investors were left on edge, fully aware that every decision, every trade, and every rumor could dramatically alter their financial positions in a matter of minutes. The fourth day of the silver crisis brought a new layer of complexity as global economic and political factors began influencing market behavior. Silver continued to fluctuate between $21.50 and $22.10 per ounce, reflecting a total decline of nearly 15% from the pre-panic levels. Investors were now not only reacting to immediate price movements but also to geopolitical tensions and economic reports that hinted at further instability. Rumors of changing interest rates, inflation forecasts, and international trade disruptions fueled additional uncertainty, leaving traders and investors on edge. Morgan Stanley's earlier decisions still echoed throughout the market. Analysts estimated that other major financial institutions were reducing their silver exposure by 50 to 60%, with some funds even selling speculative positions entirely. Retail investors, already shaken by previous losses of up to 12 to 14%, faced mounting pressure to make quick decisions. Social media sentiment reflected widespread fear, with nearly 85% of posts showing concern or pessimism, further amplifying market anxiety. The psychological impact of the crisis was now as powerful as the financial one, driving a self-reinforcing cycle of selling. Industrial demand for silver also started showing strain. Manufacturers who rely on silver for electronics, solar panels, and jewelry began postponing purchases as prices remained unstable. At the same time, speculative buying from smaller investors, hoping for a rebound, created short-lived spikes in price that were immediately followed by sharp drops. By midday, silver had fallen to $21.30 per ounce, representing a nearly 16% decline from the initial peak, as the market struggled to find equilibrium. Automated trading systems continued to react to these fluctuations, further intensifying volatility. Global markets outside the U.S. mirrored the panic. European and Asian silver exchanges reported similar downward trends, with combined losses approaching 10 to 12% in local currencies. This global reaction underscored how deeply interconnected modern financial systems are, where a single institution's strategy, like Morgan Stanley's liquidation, could create waves felt worldwide. Analysts warned that if the panic persisted, it could influence broader commodity markets, potentially affecting gold, platinum, and even energy prices. As the trading day came to a close, investor anxiety remained high. Silver's price swings between $21.30 and $21.80 reflected ongoing uncertainty, and many traders were hesitant to enter new positions. Experts emphasized that market stability would depend on a combination of regulatory guidance, institutional strategy, and investor confidence. For now, the silver market remained a stormy sea, with fear, speculation, and rapid fluctuations keeping investors on edge and making every decision critical for their financial futures.
By the fifth day, the consequences of the bank's liquidation had moved from immediate disruption to systemic reflection. Analysts and economists began to map out the broader implications, examining how one institution's collapse could ripple through the entire financial landscape. The early shock had subsided, but the questions it raised were only growing louder. Inside the bank, teams continued to work around the clock to evaluate remaining assets. Every loan, investment, and derivative was being scrutinized to determine its liquidation value. Regulators emphasized transparency, ensuring that creditors and insured depositors understood the process. This was not simply a technical procedure. It was a high-stakes exercise in restoring some measure of stability to a shaken system. Meanwhile, the public's awareness of financial vulnerability increased sharply. Individuals who had never questioned the security of their deposits began asking tough questions. Small businesses, particularly those that relied on lines of credit and payroll services from the bank, faced delays and logistical headaches. Communities that had counted on the bank for decades felt a void, and local economies briefly slowed as transactions adjusted to new realities. Silver, which had surged initially as a defensive move, began to draw attention from institutional investors in a more strategic way. Hedge funds and pension managers recognized that the spike was not purely speculative. It reflected a fundamental reassessment of risk in the banking sector. Physical silver inventories tightened as demand increased, while futures markets experienced heightened volatility as traders tried to anticipate the next moves in price. Economists pointed out that this silver spike was different from previous commodity rallies. It was not driven by inflation or supply constraints alone. It was fueled by fear and uncertainty within the financial system. The collapse of a single major bank had exposed vulnerabilities in funding structures, interbank lending, and investor confidence. Silver became a proxy for security in a world where previously safe assets suddenly seemed less certain. At the same time, governments and regulators accelerated efforts to prevent contagion. Stress tests were intensified for other major banks. Emergency protocols were reviewed and updated. Policymakers emphasized that the banking system remained robust, even as individual institutions could fail. Communication strategies shifted to reassure the public, emphasizing that deposits were safe, but that vigilance was necessary. Financial media played a critical role during this phase. Coverage moved from breaking news to in-depth analysis. Experts explained how a reliance on short-term wholesale funding had amplified the bank's risk. Commentators explored the psychology of markets, noting how trust, once broken, could spread faster than any regulatory intervention. Social media amplified every nuance, with discussions ranging from practical advice on portfolio protection to philosophical debates about the stability of modern banking. By the end of the fifth day, the picture had become clearer. The bank's failure was a catalyst, not just an isolated event. It highlighted the fragility of financial networks, the speed at which confidence can erode, and the tangible value of assets outside the traditional banking system. Investors, businesses, and everyday people were now reconsidering how they measured safety and where they placed their trust. The silver spike, which had begun as a reflexive flight to security, was now part of a larger story, a realignment of perception and priorities in global finance. It underscored a fundamental truth: when confidence in institutions falters, people turn to what they perceive as reliable, tangible, and enduring. And in that moment, silver stood as both a refuge and a warning that even the mightiest institutions can fall, and the consequences are felt far beyond their own walls.